Welcome to the Vaughan Nelson podcast. Today is the third quarter 2025 Vaughan Nelson Emerging Market Recap. And with me today is Portfolio Manager Kevin Ross. Welcome, Kevin.
Thanks so much, Dan. It's a pleasure to be here.
Great. Well, thanks for joining us here, Kevin. Let's dive right into it. Let's start off with, can you give us a quick recap of the strategy's performance this quarter, both relative to the benchmark and perhaps highlight a few of the positives and some of the challenges that you faced?
Sure thing. The strategy had strong absolute performance during the third quarter while lagging the benchmark slightly. Our stock selection was a key detractor as several of our core holdings underperformed its peers despite disciplined capital allocation strategies. We remain confident in the investments that our companies are making for the medium to long term and believe we will see these rewarded in the future. Industry allocation also detracted modestly and was a slight drag on performance during the quarter. But overall, we're really excited about the performance during the third quarter and look forward to stronger returns moving forward.
All right. And how about some main themes? Any main themes, market forces, anything that shaped your results, and how do they cut both ways for the portfolio?
Yeah, well, EM equities had solid gains in the third quarter, supported by a friendlier global macro backdrop and renewed investor risk appetite. The Fed's first rate cut in over a year, combined with easing inflation and a softer dollar, improved liquidity and strong EM inflows also supported performance. Asia was the key driver, with technology and semiconductor exporters in Taiwan and Korea benefiting from the ongoing AI investment cycle, while select LATAM and EMEA markets gained from resilient commodity demand and improving fiscal scenarios. Chinese policy support and enthusiasm in Chinese AI investments also helped sentiment. Some domestic-oriented economies, like in particular in Southeast Asia, continue to struggle with sluggish consumption, and you have countries like Brazil and Turkey where they continue to face inflationary pressures. Additionally, valuations in certain high-growth sectors are looking more stretched after strong year-to-date gains, and that's something we will continue to monitor.
And for the quarter, any companies, industries that you noted that contributed most to performance, and anything that was a setback?
Our top contributors during the quarter include a copper producer in Mexico named Grupo Mexico, a technology company that produces passive components called Yageo in Taiwan, and a cement producer with a footprint in the US and Mexico called Cemex. Flipping to the detractors, they were led by not owning Alibaba Group, which had a strong third quarter, Mercado Libre, which is facing a more challenging, but we think a very manageable competitive scenario. And finally, 361 WAM, which is an Indian asset and wealth manager, which lagged during the quarter, driven by more muted market activity in their home market in India.
And any specific sectors, regions, any holdings that were a little bit more difficult, and any that you'd say offered some bright spots despite those challenges?
Our relative outperformance came from our exposure and overweight to materials, semiconductors and semi-equipment, and financials, specifically banks. We saw some weakness in consumer discretionary, specifically retail, financial services, excluding banks, and media and entertainment, where we have an underweight. The industries that we avoided were a small detractor from our overall performance, but very small.
And then thinking through the capital allocation framework, and how that uses as a guide for your investment decisions, any that were kind of that case, and where it led you to avoid a pitfall as well as some potentially capture some opportunity.
The capital allocation framework remains central to our discipline. During the quarter, we emphasized return on invested capital, reinvestment quality, and positioning in the cycle. This approach helped us differentiate between companies deploying capital productively versus those expanding aggressively into lower return opportunities. One example is in India, where exuberant valuations and rapid capacity additions the last few years have created pockets of overinvestment, and the framework has been signaling rising risk. As a result, during the third quarter, we selectively exited or reduced our positions in several Indian companies. At the same time, the framework guided us towards opportunities in markets and sectors where reinvestment discipline and capital productivity remains strong. We increased exposure to companies with conservative balance sheets and high reinvestment runways, in particular in Southeast Asia and pockets of Latin America, where we see incremental capital that is still being deployed into high return, structurally advantaged niche areas.
And when you're utilizing the capital allocation framework, did you observe any notable shifts in how companies, industries, countries, how they're allocating capital, and what potential risks or limitations do those shifts present alongside your opportunities?
One market that we're monitoring closely is in China, where their increasingly assertive industrial policy aimed at achieving self-sufficiency and export competitiveness has led to large-scale capital deployment across sectors such as electric vehicles, batteries, solar, and semiconductors. While this has accelerated their innovation and reduced production costs, it has also produced clear signs of overcapacity, compressing margins and heightening global trade tensions as excess supply gets exported to other markets. We have become more sensitive to this dynamic and are monitoring this risk for our companies that may be impacted in the portfolio in the future.
And now we're talking about some changes in the portfolio. Can you touch on some new positions you added? Any risks that you're watching in those specific particular names as you begin to scale them up in the portfolio?
We added 8 new positions during the quarter, each aligned with our framework of disciplined capital allocation and having attractive reinvestment opportunities. Just to highlight a few of those, one is Hana Financial Group, a leading Korean national bank. They are gaining market share through conservative risk management and differentiated digital capabilities while returning excess capital via higher dividends and buybacks as their credit costs normalize. In the Philippines, we added a company called International Container Terminal Services. They are the world's largest independent port operator. They continue to compound value through brownfield capacity expansion and selective M&A, particularly in emerging and frontier markets, leveraging their strong free cash flow generation and a disciplined balance sheet. And then finally, in Taiwan, we added a company called Nian Made Enterprise, who is the global leader in window coverings, and they are expanding their production capacity outside of China, particularly in Cambodia and Mexico, in order to diversify their supply chain and capture incremental U.S. market share as reshoring trends accelerate the next few years. We remain attentive to the key risks in each of these investments. For Hana, in particular, prolonged margin compression or renewed asset quality deterioration would cause us to perhaps change our view of the company. For ICT, port throughput sensitivity to global trade volumes and rising competition on their concession renewals is something we're monitoring. And then finally, in the case of Nian Made, near-term operational risk comes from ramping their new facilities, and potential changes in the U.S. housing market is what we're monitoring closely.
All right, and then take the flip side here. Any meaningful exits this quarter? Any positives you had to give up in order to reduce some exposures?
So we exited 8 positions during the quarter. As our capital allocation framework indicated, weakening reinvestment efficiency, less favorable positioning, or better opportunities elsewhere in the universe. Several of these decisions reflected, as we discussed, a deliberate reduction in our exposure to India, where we see signs of overinvestment. The exit from multiple banks during the quarter, in particular one in Southeast Asia, one in Poland, and also reflected our assessment that these mature franchises, while still operationally sound, offer limited upside relative to newer opportunities with expanding reinvestment runways and more attractive upside for the portfolio.
And can you talk a little bit about how the portfolio is currently positioned, any vulnerabilities that come with that particular positioning?
We remain positioned around high conviction compounders with disciplined capital allocation and structural tailwinds, particularly in areas such as technology, digital finance, and industrials linked to the energy transition. Our largest holdings reflect the framework's emphasis on capital efficiency, reinvestment visibility, and market leadership. Each of our companies is deploying capital into areas where they have long-term competitive advantages. Looking ahead from a risk standpoint, we remain focused on valuation as the markets have performed strongly year to date. policy risk changes, particularly around trade policies and macro cyclicality as we're later in the economic cycle.
All right, and last one here for you today, Kevin. Looking ahead, what do you see that the biggest opportunities and what risks could offset those potential gains?
Emerging markets remain in the midst of significant structural shifts in capital allocation, from digital banking adoption to resource investments and supply chain realignment. In many cases, tomorrow's winners will look very different from today's leaders and the leaders of the past. Our capital allocation framework is built to identify these shifts early in the process, capturing opportunities for the portfolio where capital is deployed with discipline and high return incremental potential, while avoiding areas where overinvestment or poor capital allocation decisions erode future returns. By maintaining our concentration of flexibility, our portfolio remains positioned in what we think are the most attractive opportunities across a very dynamic and attractive emerging markets universe.
Okay, good deal. Well, thank you for joining us here, Kevin. And that will move over to returns. In the third quarter of 2025, the Vaughan Nelson Emerging Market Strategy returned 8.3% gross, 8.01% net. And that's against the MSCI Emerging Markets Index at 10.64, which brings the year-to-date return for the Vaughan Nelson Emerging Market Strategy to 28.34% gross, 27.31% net, and the MSCI Emerging Markets Index is sitting at 27.53%. Over the past 1 year, the Vaughan Nelson Emerging Market Strategy has returned 22.54% gross, 21.22% net, and the MSCI Emerging Markets Index is at 17.32. Over the past 3 years, 18.27% for the Vaughan Nelson Emerging Market Strategies gross, 16.99 net, and that is against the MSCI Emerging Markets Index at 18.21. Over the course of the past 5 years, 12.77% return for the Vaughan Nelson Emerging Market Strategy gross, 11.55 net, and that's against the MSCI Emerging Markets Index at 7.02. And finally, over the course of the last 10 years, the Vaughan Nelson Emerging Market Strategy has returned 8.86% gross, 7.58% net, and the MSCI Emerging Markets Index is at 8.03. So thank you very much, Kevin. That's a wrap on the third quarter, and we'll look forward to having you back here again soon.
Thanks so much, Dan, and we look forward to speaking again next quarter.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.